Okay, let's get right into it. We're looking at one of the wildest earnings reports I've seen in a long time, and it's from EOS Energy Enterprises. I mean, how often do you see a company post absolutely record-breaking numbers only to watch its stock fall off a cliff? So today, we're going to dig into the data and figure out what is really going on. Is this company a sinking ship, or did the market just create a massive buying opportunity? This slide right here, it tells the whole story, doesn't it? On one hand, you have this mind-blowing 700% jump in revenue. They absolutely smashed their targets. But on the other hand, a 40% stock collapse. Total catastrophe. It just doesn't add up. So how on earth does that happen? Well, to understand the panic, you have to look at what was hiding behind those incredible revenue numbers. All right, so let's peel back the layers on this thing. We're going to do a little anatomy of a crash here because, the market wasn't just being moody. It saw something in the fine print that made all that good news seem totally irrelevant. And this is it. This is the number that did all the damage. Negative 72 cents. That was the company's earnings per share. This one single number was so bad, it sent a shockwave through the system. And, all the automated trading algorithms just started dumping the stock like crazy. And the context here is absolutely everything. Look, nobody was expecting a profit. Wall Street was already prepared for them to lose about 18 cents per share. But negative 72 cents? That's not just a miss. That's a total disaster. We're talking 4 times worse than the worst case scenario. When you see a deviation that big, you know something is seriously broken under the hood. And that's the key thing, right? This wasn't just some accounting error. That ugly EPS number was a symptom of a much bigger disease. The company is having what you might call severe growing pains. Management came right out and admitted it. They're dealing with major bottlenecks in their operations, from getting parts from suppliers to just keeping their automated factory running. And if you want to know just how bad it is, look at this number. 30%. That's how often their factory equipment was just offline, not working. Think about that for a second. For nearly a third of the workday, their expensive machinery is just a giant paperweight. For a manufacturing company, that's a complete catastrophe. Now, just to put that 30% in perspective for you, a good manufacturing operation aims for 10% downtime or less. EOS is running at 3 times the standard rate of inefficiency. There's just no way, absolutely no way, you can be profitable when your factory is that broken. And here's what that looks like in dollars and cents. A gross loss of nearly $144 million for the year. That is the direct price of that inefficiency. When your factory's down that much, you're literally just lighting cash on fire. This is what the market saw, and this is why it panicked. Okay, but hold on. That's the panic. That's the bad news. And it is bad. But it's only half the story. Now, we're going to flip the script and look at the bull case, because it seems like in all the chaos, Wall Street completely forgot to look at the company's bank account. And here's the number that turns this whole story on its head. Over $624 million. That's how much cash EOS had sitting on its balance sheet at the end of the year. That's not just a buffer. That's a massive war chest. It completely changes the conversation from, are they going bankrupt, to, can they actually fix this? And if you dig into that balance sheet, the story gets even stronger. So they've got that huge pile of cash. They also managed to push their major debt payments way out, past 2030. And, this is a big one, they got rid of that dreaded going concern warning. That's basically their accountants saying, okay, we think they've got enough money to stay in business now. They have bought themselves a whole lot of time. So they've got the money to survive. But do they have customers? Well, this is the other thing the market seems to be totally discounting. Demand for their unique zinc battery technology isn't just strong, it is absolutely exploding. Check this out, $701 million, that's their backlog of confirmed orders. These aren't maybes, these are real customers who have signed on the dotted line and are just waiting for EOS to build the stuff. And then there's this number, which is just staggering. $23.6 billion. That's the size of their commercial pipeline, the potential deals they're in talks for right now. So let's be crystal clear. The problem isn't a lack of buyers, and it's not a lack of cash. The one and only problem is that they can't get their factory to work properly. Okay, so you've got this huge problem on one side and this gigantic opportunity on the other. How do they bridge that gap? Well, they have a plan. And everything, I mean everything, comes down to what happens in the second half of this year, 2026. The turnaround plan basically has two big moves, both scheduled for the back half of the year. First, they're launching a brand new product design they're calling Indensity. And second, they're bringing a whole new redundant production line, Line 2, online. These are the two catalysts that every single investor is watching. And this Indensity product isn't just a minor tweak. It's been engineered from the ground up to solve the exact problems we've been talking about. Yeah, it improves energy density. But the real magic is that it's designed to be way, way easier to actually manufacture and service. The whole point is to take that horrible 30% downtime number and just crush it. So this brings us to the final verdict. When you cut through all the noise, the entire investment thesis for EOS right now boils down to one classic battle, a massive opportunity versus the ability to actually execute. In the investing world, we call this execution risk. EOS has the strategy. They've got the customers lining up, and now they have the funding. The risk of them going bankrupt is pretty much off the table for now. The only question, the big question mark, is whether management can actually deliver on its plan to fix the factory. And that really is the multi-million-dollar question that sums it all up, isn't it? If they can actually fix their manufacturing bottlenecks by the end of the year, this 40% crash could look like a generational buying opportunity a few years down the road. But if they can't, that giant pile of cash is going to start dwindling very, very quickly. The entire future of this company rests on the answer to this one question.